lên nào.
Hello, everyone. Hello, can you hear me?
Hi,
Hi.
Michelle. How are you?
Hello, hello. Welcome,
Hey.
everyone. Can you hear me all right?
Yes,
Okay,
perfectly.
great. Okay, perfect. So, welcome to the Food, Beverage, and Agriculture Investment Conference at the Startup Club. My name is Mathilde Bade, and I'm your host tonight. I am currently in Sweden on vacation. So, or typically, I am based in Prague, but now in Sweden. Happy to have you all here tonight. I will share my contact details in the chat, and you can do the same to network with the other attendees and the investors. I will also share the schedule and the link to the pitch decks. Tonight we have 4 companies. And yes, if you want, you can use the general chat or private messages to ask questions to the presenters. Shortly about the Startup Club, we are a one-stop shop for the global entrepreneur community. Our vision is to assist businesses in their funding rounds and growth. We do that by connecting entrepreneurs with investors, advisors, and mentors in the startup ecosystem internationally. We do this through pitch nights and investor networking conferences. All are virtual at the moment. We have pitch events in different industries, for example, also health tech, green tech, fashion, beauty, luxury, SaaS and marketplaces, hospitality and lifestyle, real estate, prop tech, deep tech, AI, plenty of different ones. So I will also be sharing free tickets in the chat if you are interested to join and listen in the future events. So, as I said, tonight we have 4 companies within the food, beverage, and agriculture. We have, as a first one, SUR Coffee, farm to cup, high quality, freshly roasted specialty coffee with Mark Bell. Second one is CRUMBS Bakeshop, a legacy bakery brand launching some of the industry's most innovative and disruptive baked goods lines into supermarkets and convenience stores all across the US with Jason Bauer. Third one is Nitro Blends, a patented vacuum infusion technology transforming the nitro beverage dispensing equipment industry with Bill Postitz. And the fourth one is called Enviro Farm, leading the way in land regeneration, climate adaptation, and sustainability management, presented by William Tooley. So we should be running for an hour and a half. The event 7:35 we should be finished according to the schedule in the European time. We have 6 advisors. We have Oliver Stahl, we have Peter Dorfner, we have Amit Grover, we have Bryan Musicar, Michael Gilvary, Ben Friedman, and I will ask the advisors to introduce themselves. It's easier. So let's start with Oliver Stahl. Would you like to introduce?
Hi,
Yes.
I'm Oliver. I'm from Liechtenstein. I'm a business angel for like 10, 12 years now. I built up first 2 ventures, which we sold to Selecta. This is the European vending operator. We did 2 exits. Before Corona, we were a B2B office delivery service, so we were really lucky in time. And I have a portfolio from about 25 F&B startups.
Perfect. Very nice. Welcome at the event. Peter, would you like to go next? Peter Dorfner? No? Maybe he hasn't joined yet. Amit?
Hi, Mathilde. Nice to be
Hi.
here again. My name is Amit Grover. I come from New Zealand. I'm a Kiwi. living in Dubai for the last 8 years. So I run a very large IP strategy practice globally for the last 21 years in about 6 countries with over 400 people. And I also run a single family office that specially invests in research capital at the CRISPR level, so gene editing in crops. So we've got joint venture with a few select universities that are subject matter experts in that area. We provide them research capital, help incubate IPs, and then sell IPs to Fortune 500 companies. IP is my life, and that's pretty much what I understand for the last 22 years. So that's me.
Thank you so much, Amit. Nice to have you at the board again. Let's ask Bryan to introduce himself.
Hi, good morning. I'm Bryan. I'm from Chicago, and my company is Invictus Holdings, which is a private equity shop that we're operating in a number of countries, doing financing of energy infrastructure projects, a lot of food commodities, and primarily banking type of assets for people that are looking to expand their businesses, etc. Do a lot of work in South Asia, in Middle East, and a lot of food commodities coming from Mexico into US, Japan, Canada, and some Europe.
Perfect. Thank you so much for the introduction. Michael, would you like to go next?
Hi, everybody. Mike Gilvary. I'm a former entrepreneur in the health tech space. Started investing in venture debt about 5 years ago. I'm on my second fund now, primarily focused on health and wellness and CPG.
Thank you, Mike. And now we have Ben Friedman.
Hi everyone, Ben Friedman. Company name is Green Road Innovation. Basically, we are an agri-food tech venture platform. I'm originally from Israel. We bridge India and Israel in terms of innovation, expertise, and market opportunities. We have 3 core activities. One is consultation and project management. The other one is incubation. We support startup and entrepreneurs, venture building, scaling the innovation ventures. And the last one is venture capital. We have an angel club that we supporting companies in early stage and early growth stage also.
Perfect. Thank you so much, Ben. Are you here, Peter? No? Okay. Maybe we'll join later. Shortly about the format. It's 20 minutes in total to pitch and for feedback. So I have instructed presenters to pitch for 8 minutes and then will be 12 minutes feedback. If someone pitches longer, the feedback part will be reduced. So I really recommend to keep it at around 8 minutes. There will be a clock ringing at 8 minutes and again after 20 minutes. Yes. I think this is it. We can go right into the first presentation, which is SUR Coffee with Mark Bell. So Mark, welcome.
Hi,
And
how's it going?
yeah, good. So whenever you're ready, you can share your screen and I will start the watch and you can start the pitch.
Right. Got a hot latte for Andre?
There is no sound, I think.
All right, can you guys see all that okay?
Yeah, we can
Started
see
out with
it.
our commercial. Okay.
Yeah.
Good morning, everybody. I'm Mark Bell. I'm founder and CEO of SUR Coffee. Over the last decade, we built SUR Coffee from being a small little roaster in my garage and a single neighborhood coffee shop into 5 locations and growing. We've traveled the world building direct relationships with incredible farmers. And we built a brand rooted in adventure, craftsmanship, and community. Today, I'd like to share why we believe that SUR Coffee can become the world's first truly global lifestyle brand. Most coffee companies are just trying to build great coffee businesses. But I think that there's an opportunity to build something different here. Coffee is one of the few products that people enjoy every single day, probably lots of you. It's part of people's daily routine, and it's our ritual. Companies like Red Bull, Patagonia, and Yeti became much more than the products they sell. They built brands that people connected with. They built communities, and they created culture. That's the gap we see in coffee today. And after 10 years of building this brand, we believe SUR Coffee is perfectly positioned to fill that. Coffee's already a $500 billion global market. It's the second most traded commodity in the world, yet no company has become the defining lifestyle brand in that category. We see a massive opportunity to build a premium brand that connects exceptional coffee with adventure, culture, and community. And we don't believe our advantage is just one thing. It's a combination of everything we've built over the past 10 years. It starts with direct trade relationships that produce award-winning coffee. We've built the company here in Southern California, one of the most influential coasts in the world, from fashion and music to sports and entertainment. We've earned authentic relationships across surfing with MMA, action sports, and our local communities. We've become the clubhouse for both local legends and professional athletes. We have a proven retail model with 5 locations and growing, and we're scaling through wholesale, e-commerce, and we believe that together this advantage creates a flywheel that's really difficult to replicate. And authenticity is at the center of everything we do. We work directly with coffee farmers, creating better coffee and better impact. At the same time, we built genuine partnerships through surfing and coastal culture. These relationships weren't bought. They've been earned over years of showing up and being involved. I think it's funny how Red Bull athletes, they get paid hundreds of thousands of dollars, yet they show up in my cafes every day and drink our coffee with us. Retail isn't just where we sell coffee, it's where we build culture. Our cafes are where the SUR brand comes to life. A place where people gather before a surf, after a workout, before work, or really chasing whatever they're passionate about. There's pro athletes and artists, entrepreneurs, local legends, they all intersect there. That community becomes the engine that drives our retail, wholesale, and e-commerce and subscription businesses. Our goal is to build the defining brand on the California coast and then export that lifestyle to the rest of the world. Coffee has become more than just a commodity. It's a part of people's identity and their daily ritual. The next generation is looking for brands they identify with, and we believe there's never been a better time for a premium lifestyle brand. We've already demonstrated a lot of traction with 5 locations in prominent beach towns, our strongest revenue month ever last month, international coffee awards, growing wholesale and subscription programs, strategic partnerships, and expanding brand awareness. We have signed LOIs for open distribution, and we've secured important IP. And we're building on a proven foundation with a ton of momentum right now. We've also assembled an incredible team that combines expertise in global consumer products, especially coffee, operations, and community building. From Fortune 500 executives to world champion athletes, we've surrounded ourselves with people who've spent their careers building communities, growing companies, and performing at the highest level. Our board's made up of founders, CEOs, and operators who've already built iconic companies. Their experience helps us avoid mistakes, move faster, and scale with discipline. We've built a business with a proven foundation and multiple engines for growth and scale. These projections represent the opportunity that we see as we continue executing our strategy across retail, wholesale, and e-commerce. So to summarize, coffee is our product, adventure is our brand, and people are our purpose. We believe SUR Coffee is perfectly positioned to become the defining lifestyle brand in coffee, and we're building it. Thank you, guys.
Thank you so much for the pitch, Mark. Let's begin with Oliver.
Thank you for the nice presentation. You said something about an IP. What's about this IP here? It's in the roaster mechanism,
Sure.
or?
Yeah, it mainly is around our marketing. So we were able to secure the ritual of adventure, which has kind of become our tagline for where we're trying to build this company. We also obviously threw, some logos and some of our branding.
So, but the coffee itself, it's not an IP or there.
Yeah, we have kind of our own proprietary ways that we're roasting with our roast curves, but we have not secured an IP directly on those roast curves.
Okay. Nice.
Thank you, Oliver. I see Peter has joined the call. Hi, Peter. Hello, Peter. Can you hear me? Okay, let's continue with Amit.
Yeah, hi. Look, great presentation, great brand. I know a little bit about coffee. In my previous lifetime, I was heading a coffee brand called Lavazza Coffee that I built in Europe, took them public, and took them across Southeast Asia. During my entrepreneurship experience in the last 22 years, I built a very similar brand to yours, which have over 150 stores across New Zealand, Australia. It started from New Zealand. It's a New Zealand brand. Look it up, called Mojo Coffee. It's all about farm to table. It's all about sustainability. It's all about community and culture. It's a company-owned model, not a franchise model that typically that you see in coffee business. Based on a little bit of that experience and helping them build their IP on not only the roasting, but also the genetics of coffee bean that they cultivate with farmers in Jamaica, and Cuba, and in the likes of Ethiopia that they're currently working on to get the right kind of coffees that Aussies and Kiwis love. So that's where the IP comes from. Now, I understand what you're trying to do. There are two aspects. I'm going to start with my observation and then follow up with a couple of questions. My observations is it's a low margin business and a highly capital intensive business as far as securing the coffee is concerned and turning that into a great beverage is concerned. I think it would have helped to look at a deck with store level P&L, customer acquisition cost, payback period, and what's your strategy to kind of compete with a lot of similar brands like yourself. I at least know 15 of them across the world that are trying to take a different position, but trying to, in a sense, do what you're trying to do. Now, you've taken adventure as you're driving and somebody's taken something else as they're driving it. So from my concept, what are your store level economics across your 5 locations that you're talking about? It'll be really good to know. I didn't get your deck, so I couldn't analyze that. And what are the actual, I don't know whether you're raising capital. If you are, how much capital are you raising and what are you going to use it for? So this would be really helpful to know.
Yeah, that's good feedback. I appreciate that. Yeah, our focus right now is scaling. We proved the model with specifically in action sports. If you think about it's here in the US, we have legacy brands of coffee, and we've had one actual semi lifestyle brand that popped through, which is Black Rifle.
Yeah.
They obviously came on the scene. They're specifically focused on first responders, military, and some of my board members are connected with Hayford. So built a great brand, not a great coffee, isn't direct. It isn't a direct trade coffee, and specifically, it's built on a very small portion of people they're trying to hit, but we're very successful as a brand. And that's something that we're trying to do is we're capturing, if you think about, it's just crazy to me that no one has become the Red Bull of coffee. No one has stepped into that space. No one has really, because I live in all those spaces and I come in contact with the Monster and Energy guys, yet we're the only coffee that's popped up here in the US specifically on the West Coast. So a lot of that has to do with our community and the people that are connected to us. Every single pro surfer who's in in the WSL will be in my shop as they come through Trussell's. The Olympics is going to be here and held in our hometown with our flagship store in San Clemente. So we have a lot of traction in those communities, and I think there's a lot of potential to become that brand that's kind of fragmented at the time right now in those specifically in those communities.
Right. So, Mark, you said that you're going to end the year with $6 million, about $6.5 million in sales. Is that correct?
Yeah, that's our target right now. Yeah.
And where are you right now as far as July is concerned?
I'll have to refer to my CFO. Ina's on the call.
No worries. Thank you.
But I believe that as we're heading into the summer, I believe that we're probably a third of the way there. And the summer is always from now until basically September, it's our busiest months. I mean, our shops are constantly filled, obviously being on the coast. So we'll experience most of our growth specifically through the summer months.
Right.
Okay, thank you, Amit. Bryan, would you like to go next?
Hi, morning, Mark. So I'm Bryan. Are you in San Clemente or are you in San Diego?
I'm in well, we have a shop in San Diego as well, but I'm currently in San Clemente. Yeah.
Okay, I grew up in La Jolla, so I know San Diego really well. It's my hometown.
Yeah,
okay,
good.
Can you knock us back a couple of slides to your numbers, please?
Sure.
The one that had your EBITDA figures, because we got some other stuff in there that was really not well defined. Okay, that's the slide. Okay,
Perfect.
Looking only at 25 and 26. Okay, so I'm trying to understand what your core business is because you've got a cute story here, and that's fun. Is the business a coffee shop? Is this the business the sale of the coffee? Of that coffee, how much of your business revenue is actually generated on the sale of coffee, and how much is it on muffins and snacks and scones and all the other fun Starbucks goodies? So I'm trying to understand what the coffee business is actually generating.
Sure. Yeah. Right now, a majority of our revenue has come through our shops. That's what we're trying to do, is leverage the momentum we have in these shops to continue to scale our online. Again, coming back to Black Rifle, they built a $1 billion valuation business on subscriptions specifically. So we've been kind of reorienting and starting to focus in on a subscription business, which is really, that's,
How many users do you have?
Currently, we have over 200 in the last handful of months. So,
Okay, what's your
that's
cost
that
of
we're going to
customer
start.
acquisition?
I don't have that right now. I'll have to pull that exact number.
Okay. I hate to say this.
Something.
I'm going to be that guy and be like,
Yeah.
why do you not know your numbers? You should have your numbers like at hand, because someone's going to ask that. Okay, quick question then, hitting your EBITDA figure, because you're looking at hitting 630, which is great, but what's your debt profile look like? What's your debt service looking like?
Ina, I'll refer to her on that.
Okay, so you see the problem is immediately you don't have the ability to answer the questions about the core business model. Do you know how much coffee you're importing every year and where you're importing it from?
Absolutely. Yeah.
Okay.
By the way, Ina's on the call. She can answer, I think.
Yeah, we'll import almost 150,000 pounds this year. Primarily, a lot of ours is coming through Central America. We buy a lot from Guatemala, Costa Rica. There is some South America and Ethiopia. Most of those places we've gone in direct relationships with those specific farmers and bring that in, so we're able to kind of control costs through the negotiation specifically with those farmers.
You're bringing in 3 containers. You're bringing in between 3 and 4 containers a year right now.
Right now, yeah, our focus is we're trying to 5x with the Loring that's coming in right now. We're getting that operational shortly. So the goal is to bring in 500,000 pounds a year on that.
Okay, so right now you've got 68,000 kilograms, which is really about between 3 and 4 containers worth of stuff.
Yep.
So this is very, very small amounts. I'm assuming it's all
Absolutely.
single source. It's single source high altitude coffee.
Yeah, absolutely.
Okay. So what makes you different than Bulletproof? Bulletproof is already doing this. They're already in the thing. They've already got a lifestyle thing going on. That's through Dave Asprey. They've been picked up by Amazon, so Amazon is pushing them. What makes you special?
Yeah, they're a little farther down the road maybe than we are. You know, obviously, and Bulletproof is a little different product specifically. So we're leveraging, you know, our community towards specifically coffee. I mean, direct trade. I mean, I don't understand completely on the Bulletproof model because I haven't studied their model specifically, but it seems like that's a little bit different
It's
in the product.
not far off from yours. They even have shops in Santa Monica. They do the whole Bulletproof coffee thing where the coffee mixed with the
Yeah,
butter and
yeah,
the
I
coconut
see
oil,
that.
but it's
I see that
fundamentally a
around.
coffee company. So
Yeah, I see it around, but it is not prominent on the West Coast, honestly. Not in the circles that we go to.
so it's big with the keto people.
Yeah,
And
for sure.
but the thing is it seems like there's no barrier to entry. I'm not sure what your debt profile is. This seems like it's a story without underlying business fundamentals. And I'm a bit concerned that this is an uninvestable business until you make some further progress.
Mm.
So I would really, if you're going to be taking this in front of people to sit there and really try to get this going, you really got to know your numbers and you really got to dig into those kind of things, sir.
Yeah, I'll definitely get into the cost of acquisition. I appreciate that feedback, Brian.
Hey, good luck.
Thanks.
Thank you. Michael, would you like to go next?
Sure. Hi, Mark.
Right.
I am based in Santa Monica,
Awesome. Yeah.
but I just moved here a couple months ago. So I don't know, and I don't drink coffee personally, but I know the scene, and I have a feeling of what you're trying to capture. My specific questions would relate to what Amit and Brian are talking about. And just from a feedback perspective, are you raising money?
hmm Yeah.
Okay. So I just think you would be helping yourself if you dive into some of the unit economics,
hmm
location economics, specific ask, and then what is that ask for? Because my questions are going to be, and you can answer them if you like, or you can just think about it for the next time. But my questions would be, what's the revenue split across cafes, wholesale? What are the numbers for DTC? What are the growth numbers? They're kind of different, almost different businesses, within a business. So they need to be broken out so an investor can understand how big is the D2C business? What's the growth plan for that? Is that where the money's going? Is the retail business healthy and profitable and going to be okay? And that's going to like what's the balance of all of this? Is going to be the question. Storytelling, I get it. There's you would benefit from some substance financials in the presentation.
Thank you. Yeah, I appreciate that.
Thank you, Mike. Ben, would you like to go next?
I just had the question that actually it's been answered. I just wanted to know, where do you source the beans, the coffee itself? But you pretty answered so.
Yeah. Okay. Thank you. Peter, are you on the call?
Yeah, sure. I want to call pardon. I had some
great.
issues actually joining in the beginning, so I was only able to dial in at like 10 minutes ago. So very sorry, I missed half of the first pitch. I beg to apologize. So I will have to refrain, unfortunately, for questions for the time being for the first one.
Okay. Well, maybe you can write it by email if you have some points later on. Thank you. Okay, great, Mark. Thank you for the pitch.
Thanks,
Perhaps
guys.
if we have a few minutes, is Ina there? Is she able to answer some of the financial questions that were asked? Can she have a moment to do that? Because all these have been
We
addressed.
are so very shortly because we already 1 minute. Now it's the beeping.
Time step.
But I don't know. Yeah, so 1 minute it's okay.
Okay, Ina, if you want to go for 1 minute, if you have any answers to their financial questions, that'd be great.
So some of the debt issues. So we do have some significant debt that we do want to reduce. We do need to get the absolute percentages and numbers for the deck, and cost to acquire the same thing. We need to actually get those into the deck. We do have some of that information. We do have information as far as a four-wall, where we can tell you exactly per square foot what we're able to generate and what the EBITDA is at that point. So that we appreciate the feedback of that, and we will add a lot of that information, which we actually already have, but we just needed to include it in the deck. Thank you.
Ma'am,
Yes.
just looking at your 25 numbers there, you showed the EBITDA number. What was your actual loss as per your taxes? Because by the time you include all of the debt payments on this is going to be a lot lower. And all you're doing is increasing the store count up to 2030, which is also going to be all debt driven. And the problem is if you're paying any kind of normal interest rates, I mean, even if you're doing it through standard banks and not paying anything too egregious, it's just going to eat up your debt service is going to eat up your profit margins.
True, but we are hoping with the raise that we are able to eliminate that debt. So it's not as significant as you would think, the number. So it'd be
So you're
fairly
going to
easy
swap
for us
debt for
to
equity.
a little bit, yes.
Okay.
Or may I ask, jump in here, what's the current debt level of the company actually?
It's
How much
about,
of the raise you want to use to like kill off debt?
I would say about, I'm looking at probably about 15%, 10 to 15% of the raise would be to reduce the debt.
Okay.
But what is the total debt position right now, I think is the question, ma'am.
So it is running about, I would say it's about 30%.
Of what?
For revenues or?
Oh,
Yeah,
yes, sorry, yes. Yes, so it's running about 700,000 right now.
So you have
would
seven,
cut it
is that
in half.
is that an SBA loan?
A part of it is, yes.
Okay. And what's the coupon on that?
You mean the number of years that the
No,
20
no, ma'am.
years?
Your interest rate.
Oh, it's I think it's 8%.
Okay. Yeah, a lot of your revenue is going to get eaten up by that, and by the time you end up paying some tax on it and paying yourselves because nobody works for free, there's not a lot left in this.
Well, not at 2 million in revenue, no.
No.
It's a
But
startup.
6 million, even at 6 million revenue, and all they did was double the numbers, or they proportionally made it bigger here. There's a problem is this is going to be a major debt position to move this up, or you're going to be coughing up all your equity. So there's a challenge.
Okay. Thank you for the feedback. Thank you, Ina. All right. Thank you all for this was the first company, SUR Coffee. We will now move to the second one, which is called CRUMBS Bakery with Jason. So Jason, whenever you're ready, you can share your screen and start the presentation.
Okay, I'm just requesting permission.
Yes, I can see your screen.
Okay, can everyone see my presentation?
Yeah, it's not in full screen, but
okay, give me 1 second. I'll move this over.
Yes, perfect.
How's that?
Yes, perfect.
Okay.
Okay.
All right, let me just start my timer. Good. Okay, thank you, everyone. My name is Jason Bauer. I am the co-founder of CRUMBS Bakeshop along with my wife and partner, Mia. CRUMBS Bakeshop, for those of you who have never heard of the brand, is a legacy brand that we started almost 23 years ago in 2003. We opened up our first store in 2003, and over a course of 10 years, we opened up 50 brick and mortar retail locations. We are credited for inventing gourmet cupcakes. We are credited for creating what became known as the cupcake craze for many years throughout the country and internationally. We were selling almost 1 million cupcakes out of our stores. In 2011, we were approached by a SPAC when no one knew what a SPAC was. And we ended up exiting the business and selling it to the SPAC, an enterprise value of $80 million, over 700 employees, and a four-wall EBITDA of about 15%. My wife and I exited the business at that point. Fast forward 4 years, it took the new ownership 4 years to completely destroy what we built and bankrupt the business. All stores shut down in 2016, which was, very much a dagger after putting, 10 years of our blood, sweat, tears, money into the business. The misstep that they made, the SPAC hired the former chairman and CEO of a clothing company called Stahl, which is a very large chain located in basically every mall in the United States, thousands of stores. That's the world he lived in. That's the world he knew. They ended up changing our model and opening up stores in malls. Within a year of taking over the brand, they opened up 25 stores in malls, and the thought process was they would become the next Auntie Anne's or the next Cinnabon, which live in malls. And that just wasn't the DNA of our brand. That didn't work. And within a year, all 25 of those stores failed. And when you sign a 10-year lease with a mall operator, you just can't walk away from it. They filed bankruptcy and ultimately never recovered from it. And like I said, 4 years later, it was gone. They didn't have any passion or love for the brand. It was very much just a finance play that didn't work out. My wife and I had the opportunity. We found out during the pandemic that the CRUMBS IP had become available. We ended up buying the brand back for $350 during the pandemic. Fast forward another year after the pandemic was done, we found out that we were the rightful owners of the CRUMBS brand, and we spent some time repositioning the brand, deciding how we were going to bring CRUMBS back, being that it was very much a legacy brand with millions and millions of fans throughout the country. We ultimately decided to shift gears and launch a line of CPG products for supermarkets and convenience stores throughout the country. We've been at it now for 2.5 years. We have a supermarket division selling cupcakes and cakes to the largest retailers in the country, including Kroger, including Albertsons, including Target. We're in approximately 3,500 to 4,000 supermarkets today. We also have a convenience store division selling a cooking line to the largest convenience stores in the country, including places like 7-Eleven and Circle K and Casey's and so on. We're probably in somewhere between 12 to 15,000 doors on that line today. We are a super asset-light model. We went from having 700 employees to now we run the business with about 10 people, more than half of which are fractional. Last year, we did about $3.5 million in revenue. When we launched those new lines, we were profitable. We have no burn. We have no debt other than some purchase order financing and inventory receivable factoring that we do, which provides us great access to cash flow. We borrow money at 1% a month. So that's super helpful for cash flow with no burn. Our margins are significantly higher than the industry standards because our products are so unique and we have great brand recognition. We're positioned as a premium brand inside the supermarkets, our margins range from 48 to 52% are our gross margins. So when we have to borrow money at 1% a month, doesn't affect our bottom line whatsoever. We have successfully shifted from a brick and mortar business to a CPG business. Currently, we are launching a new line of products into the market as we speak. On the left, you'll see our colossal cupcake. In the middle, you'll see our line of piñata cakes, and then our new line as well of giant cupcakes on the right. Those top three items are our supermarket line of products. We look to find innovative, unique products to bring innovation and differentiation into a stagnant category, which is a cake category inside of supermarkets. When I say stagnant, there's not a lot of innovation. It's still $1 billion business, but there's not a lot of innovation. Our products offer innovation. The new line of piñata cakes that you see in the middle, we are in the process of manufacturing and shipping right now to Kroger. Their initial POs were $1.7 million just for the opening PO. They came back and asked us for a 1-year exclusive on that line. That line, as you can see, is unlike anything else that's in the market. It's a cake that's designed to be like a piñata experience. So when you cut the cake open, the inside of the cake comes pouring out, and it's filled with different types of candies. We created molds and worked with our co-mans on equipment so that we could commercialize this type of product that's never been done before. Kroger loved it so much, they asked us for an exclusive. For that exclusive, they guaranteed us about $10 to $12 million in business annually just with Kroger. Obviously, we said, okay, we were able to carve out Target, which does not compete, according to Kroger, in that segment with them. So we are launching this line as well into 600 Targets in August as well. Those orders are in-house today. That's almost $500,000 just for the pipeline fill for Target. The bottom half of that page is our convenience store line of cookies that we call Chubbies. Those are handmade buttercream cookie sandwiches. And those cookie sandwiches are a frozen thaw and sell program. They have a 60-day shelf life, which is tremendous. Our accounts love that. And they're in, like I said, 10 to 12,000 stores as well. That comprises our line today with lots of new products in the pipeline. We currently sell the biggest, and the best in the country. These are some of the accounts on the right-hand side that we'll be expanding to as well. This is our current distribution on our supermarket line. As you can see, we're national, the biggest accounts in the country: Target, Kroger, Albertsons, and so on. This is our convenience store distribution, headlining with 7-Eleven and Circle K and Casey's and others. And this is growing tremendously every month. Talk a little bit here about the size of the categories that we participate in. They're all, multi-billion-dollar categories: cupcakes, cakes, and cookies. And we are doing our job to find pockets and opportunities to take advantage of our uniqueness. This just talks about our customer trends and our nostalgia. We'll share the deck with you so you could, read through this more thoroughly. We have a very strong consumer following because of all the years of selling our products. Every celebrity, whether it was our stores in New York or LA, have come through our doors. We have a very robust social media program. I don't want to skip through that. This slide talks about our projections. We're on target to hit our 2006 projection of $8 million, which, I feel is a tremendous feat given the fact that, we really have 3 to 4 full-time employees. This is all done fractionally. We will expand our distribution into new chains. new products into our existing chains, and we are very confident with our projections to grow this business, as you can see here, with our current footprint and our current product line. We are in the process of doing a $3 million raise, a convertible note, the majority of which will go towards building a real sales organization and marketing. Like I said, I'd say our biggest weakness is that we just don't have a solid team. Most of it is fractional. I'm impressed that we're able to get to where we are with a fractional team. But with the fractional team, you see fractional results. So we need a real sales organization to focus on additional doors, additional distribution points. And the other part of the use of proceeds will be for marketing. Wherein, like I said, 15,000+ doors, we need to spend real money on marketing. We have a robust social media following now. We work with influencers, create a lot of great content. You can follow us at Original Crumbs or our platforms. But now that we have distribution, we really want to spend some money on marketing, on some real marketing. One other piece. This is our team today. Like I said, it's a small but nimble team, most of which are fractional.
Yeah, I'm sorry.
I think that's
yeah, it's only 8 minutes left. I would recommend to go to the Q&A. Yeah.
Sounds good.
Perfect.
Please.
Thank you for the pitch.
No
Okay,
problem.
Amit raised his hand first.
Look, great presentation, yeah, and kudos, Jason. I mean, you're trying to revive a brand which has been a household name for a long time. Now, I'm going to start with a comment and then follow up with a question. So obviously, the category that you're trying to create is very fragmented and commoditized. I mean, everybody knows that. With private label and established players like Hostess, Little Debbie, and Tasty Kind, they kind of have a large presence on shelf space. And look, nostalgia alone in 2026 and going forward is, to me, I mean, my understanding is not going to win the game. So from my perspective, I'd like to understand currently what percentage of your current revenues comes out of Kroger, because I get the feeling there is heavy dependence on that supermarket chain. Yeah. That's number one. And followed by something very interesting, because your piñata cakes are very, very unique. Now, I wonder if you've got any kind of defensible IP, because what is the barrier here? I mean, if you don't have IP on the products that you're putting on the shelf, your competitors can come and copy you, competitors that have got a bigger reach and a bigger hold than you. So these are two questions. Number one, dependence on Kroger. And number two, do you have any defensible IP in the innovation that you're doing?
So currently, our revenue is split pretty much down the middle between our supermarket division and our convenience store division of cookies. That will change, right, once we launch this new line with Kroger, where Kroger will become our largest customer for sure. But not much far behind that will be Target as well, because we're opening with 600 doors as a quote unquote test, and we hope to expand to 3,000 doors. Our product line, we created this line of piñata cakes to be 60 days shelf stable. So Target loves the fact that there's a shelf stable item that they can bring in their bakery departments on their bakery tables, because they only have 250 stores that have bakery cases. So having a shelf stable line enables us to open up more Target locations. But our goal is to always find that right balance between our supermarket division and our convenience store division. And we just launched food service and unattended retail. So we believe over time, cookies and cupcakes will still be about 50% of our business when you add in all of the cookie business that we're doing as well.
Let me ask you a direct question. Do you know anybody who's doing piñata cakes in the US?
Okay, right? So yes, I'm very familiar with everyone out there that might be doing it. Yeah. We own the name Piñata Cakes. Let's start with that. Okay. Yeah. We own the name. We've trademarked that. There are certain accounts that make custom piñata cakes in their bakery, right? So if you go into a store and you order a custom cake, there are certain chains like Publix and H-E-B that will make a custom version for you for $50, $75. There is no other company that's been able to figure out a way how to commercialize it and make thousands of these a day to be able to supply.
I'm going to stop you there. For me, if I look at from my own personal lens, I think you circle the piñata cake, put 100% focus there, and make it commercially available in the US. That's your moat. That's going to make you $1 billion. The rest you're going to compete with 100 other players out there. So to me, that's your IP. Figure out a way to protect it. Figure out a way to commercialize it as quickly as you can across the country, because that's not something
100%.
that's available everywhere. So that's my suggestion.
100%. Thank you. Yep. Thank you.
Thank you, Amit. Peter raised his hand.
Is there any kind of seasonality in your business? I'm from Europe, so it's more difficult to understand the ceremonial background behind it. But very often baked goods have a high around the winter season when it's colder, while in summer, like sales are a little bit more off.
Sure. No, it's a great question, and we know that really well because we had 50 retail locations, so we know, right, the seasonality of baked goods. If you look at the calendar, every single month, basically, whether it's Valentine's Day, whether it's Easter, whether it's Mother's Day, Father's Day, Thanksgiving, Christmas, New Year's Eve, there's always some holiday within that month where we drive baked good sales. In addition to our everyday varieties that we offer supermarkets, we also have what's known as LTOs, limited time offers. So we are constantly introducing for small windows an Easter cake or a New Year's Eve cake or a Super Bowl, cupcake. So we have our everyday items, and then we layer on our LTO items on top of that. And we do a lot of that with Kroger, with Albertsons already.
And which proportion is like core product lines, and which proportion is specialties, and how do they perform on velocities?
I mean, I would say that, based on historical data, the LTOs probably represent less than 10% of our overall revenue, for our lines. It's made up of the everyday sales. They're just quick pops, truckloads here, truckloads there, and you move on. But no one ever wants to get stuck with any seasonal products, so they never order that much, just enough to sort of fill the pipeline.
Got it. Thanks.
No problem.
Thank you, Peter. Oliver raised his hand.
Yes, thank you for the presentation. I really like the second wave of your story when you rebuy the right of the scrambled bakes. Just the first a comment, and secondly a question. My comment is more personal. Is it really necessary to show the past of your story? And I felt a little bit your frustration, especially about the managing director of your SPAC. So is it really necessary to show this in a pitch deck? I don't think so. And secondly, this is my question. You said something about 3 million revenue, and you have lots of point of sales. How much revenue you do per store?
So the velocity, we're able to get sales reports from Kroger, so we're able to check our velocity. We were given a goal of hitting 1.5 to 2 units per week per store per flavor, and we're about 40% over that as far as our velocity with Kroger. That's the only chain that we get real data to measure our velocity. So we use that to sort of gauge. The rest of our accounts, we sort of just go by, tracking our purchase orders and how frequently we're getting them, and the increasing, and are we getting them faster, and increasing stores. But we don't have access to store data other than to Kroger at this point. But as far as Kroger, our largest account, we're hitting our numbers.
But you can calculate. You sold so much items to 10,000, and then you know how much you say normally could be sold per store.
Yeah, we do our best, right? To make sure that our business is not steady and not decreasing, but increasing. So we're tracking our purchase orders into each account. We don't necessarily know what store X number of units are selling in. We don't get that granular data, but we can tell you how Target is doing with our cakes, or how 7-Eleven is selling our cookies. That information we have access to.
Thank you.
Thank you, Oliver. Okay, we have time just for one more feedback, and Bryan raised his hand. So let's ask Bryan, and Mike and Ben, maybe you can write an email feedback, if that's okay. So Bryan, if you want to go give your feedback
Sure,
now.
I'll be efficient. Jason, congratulations on the exit. Two questions. Number one is, after walking away with $80 million in your pocket, why the heck would you take this thing back on? Why not just move to the south of France? And secondly, this is the real feedback. On one hand, you're showing your business to be this great thing with all of these doors that you're in, and you're selling all of this stuff, and I'm sitting there writing notes going, I can't help this guy. He's got a beautiful business. He's debt free. He's got no employees. Amazing, amazing. And then your revenue shows small business numbers. So the revenue does not fit your story. And that's the elephant in the room, is you're showing me a business that's $80 million, and then you got $8 million of revenue and not much left over at the end. I'm stuck.
Okay, so first, as far as me sitting in Nice or the south of France at a hotel, I'd like to be, but we were bought by a SPAC, and everything we received was stock, paper, and then 4 years later, they bankrupt the company before our lockup period was expired. So we did not put $80 million in our pocket. There was a small cash component as part of the deal. For us, that was life-changing money, but not to the tune of $80 million or anywhere near that. We also had partners. So, it sounds exciting and looks good on paper. Unfortunately, it was worthless paper because it was a SPAC. That's number one.
Again, and that's where you get now. We have that story of like amazing, and it's just not congruent with the financial numbers on the back end, and that's the elephant in the room.
Well, so we did $80 million in revenue, and that was the enterprise value the last go around, right? When the company was sold to a SPAC. So that's established. As far as the numbers now, we launched all of these lines in the second half of last year. So our run rate is much greater than 3 million, and we're on track to do 8 this year. And if we didn't get any new distribution, we would be close to our 20 million next year, just with the existing business we have. But we do not have a team. That's the challenge. The money is going towards building a team. It's me, my wife, and a COO. Everyone else is fractional. We're going to get to $8 million with three full-time people and 7 fractional people. It's not an easy thing to do. And then we have no money for marketing, right? We have all of these products on the shelf, but we don't have the ability to let the world know that they're there. If we don't spend money on marketing, we're going to lose our shelf space.
Understood.
That's where the money's going.
Most of the big POs, Kroger, Target, are coming second half of this year. So those will annualize into next year.
Correct. And then we're only looking to raise, like I said, $3 million, just for what we just discussed. And that will be the one and only raise that we need to do.
Thank you very much, sir.
No, thank you. Thank you, Bryan.
Thank you so much, Jason, for the pitch and for the feedback. We're running out of time, as I said, so we need to move to the next presenter. Thank you.
Thank you, everyone. Thank you.
Okay, we have 2 more tonight. We have Nitro Blends and Enviro Farm. So now is Nitro Blends presented by Bill or William. I never know which name to use.
William will work best. So
William?
appreciate
Okay.
that.
Yes. William, whenever you're ready, you can share your screen. And I'll start the clock.
Make that happen for
Need to reset the timer.
Yes.
Okay. Be good. All right. Is that coming through?
Yes.
You got it?
Mm-hmm.
Okay. So anyway, appreciate everybody taking a moment to take a look at our opportunity here. I'm William Bostic, one of the founders of TechFit. So we're going to be talking today about shaping the future of nitro-infused beverage delivery. So this is tap type. TechFit was born out of a relationship with S&D Coffee that started back in 2019. I was working with an R&D company, one of the scientists from that, Dr. Vermeulen, and
I'm sorry, William. William,
yes.
Is it just me or is your screen small? The presentation.
Yes, sorry. Yeah. If you could make it full screen.
Let's see if I can go here. How about that?
Yeah, perfect.
Thank you.
Got it. Okay. So anyway, so we were in the process of introducing our nitrogen generating technology to a local beer vending distributor, and they had a problem with their parent company providing support on an opportunity they were given to work with S&D Coffee. They called us in, we fixed the problem, developed a relationship with S&D, and the net out of that relationship was S&D asked us to develop a product to allow them to roll out their coffee concentrate product that they were developing at that time. So, of course, we rolled right into 2020. Everybody knows the COVID story, of course. So we took the capital that we were using for investment capital, and we focused on the product development. And then we secured patents. We have 2 patents on our process, and the patents are primarily focused around the infusion of a gas in a beverage prior to the tap. So that's what we own. And so we then continued with the product development, and we took the beta units, we put them out in the field, we figured out what the problems were. We had the same story as everybody else with a equipment startup. So you're going to have hiccups. You got to figure them out before you go to scale. We did that, and then came out with the final design units. We have basically 3 primary products. One's currently in patent application process. The other 2 are actually deployed in the marketplace. So what are nitro-infused beverages? So the nitro infusion process allows a virtually unlimited range of ordinary beverages to have a sensual impact change with the beverage, okay? It provides a uniquely different creamy mouthfeel. So it's a change in texture. So you can take coffee, you apply the nitro process, you end up with a creamy coffee flavored mouthfeel now with your beverage, okay? We figured out that you could use this process with products like citrus green tea and lemonade in order to apply that advantage to different marketplaces. Okay, so what would the market opportunities be? We have it's because it allows us to go into a wide variety of applications. It's more than just mouthfeel. What it does is it amplifies a single beverage flavor into 2 unique products through the infusion. So for a vendor or an outlet, if they have citrus green tea, they can have that either still or nitro. Okay, so it actually amplifies the appeal across their existing market. And it obviously provides higher margins because we're dispensing less syrup and we're actually selling the nitrogen, which we capture from the air, to the customer. So the opportunity for in the U.S. area is built around coffee shops. We've been into those extensively. QSR is an area where we're looking for a strategic partner. We have virtually no penetration there. C-stores, we have a presence in that area, and we're just now beginning to move into the direction of micro markets and corporate campuses with a recent alliance we have with KBM out of San Diego. So basically, a survey was done by Javo, and they figured out that roughly 5% of coffee consumers in America prefer cold brew to regular hot coffee. And so that market is obviously growing among the younger generation. So of the 400 to 500 million cups of coffee consumed per day, that represents a market potential of about 20 million cups per day for nitro, and some percentage of that, obviously, for cold brew, some percentage of that for nitro. So what's the problem with dispensing nitro beverages? Well, there's a picture of the problem, and here's the actual problem. Okay, this is what they routinely use along with a sparge stone to be able to deliver the nitro into the beverage. You have to have one of these to change. What? Yes, they can. In order to change the regulator out, and so if you can imagine an 18-year-old barista trying to put that item online in a specialty store, you might want to be there with a video camera. So the other problem that we're aware of is that there's a very significant carbon footprint with that process. Okay, when you start hauling around 35-pound steel cylinders to a wide range of locations, you're burning a lot of diesel fuel to make that happen. And you don't do it once a year, you do it once about every 10 days. So you've got residual costs associated with depletion of the gas cylinder, and you've got an impact on your labor relative to being able to maintain the process. So it's not user friendly. So what is a nitroblend solution? What we're doing is we're pulling the same nitrogen out of the air. We use what we got a patent on is the basically, like I said, vacuum infusion. Okay, the other processes use pressurized infusion. So they're either overpressure, like the bun machine, or they use a sparge stone regulated down, similar to what you might see in a fish tank. Okay, so that was actually part of the Guinness patent 60 years ago, and that's the technology most of the individuals try to go into, and that's most of what you see in the marketplace. There's some problems associated with that, primarily related to consistency in delivery, aside from, for the technology and the nitro effect, aside from the issues with the cylinder and so forth. We're talking to a coffee vendor down in Florida, and he's informed us that there is currently a regulatory activity occurring in the area of these nitrogen cylinders that is forcing the specialty coffee stores to have to fill out 3 pages of paperwork in order to get their, maintain their use of that product. So I have not been able to verify that, but there seems to be some kind of regulatory activity going on that they're aware of, which would mean shifting to something like this that eliminates that hassle is going to now have a potential regulatory driver as well. So competitive advantage. As I mentioned, we actually have 2 patents, both of them related to infusing gas into a liquid in front of a tap. We are also the first ones to actually integrate. The technology is so compact, we were able to integrate it into the tap head. So anybody that's want to do a tap dispensing at a countertop, they got to have a tap head. And so up until now, nobody's been able to actually get the nitro infusion process integrated into the tap head. Well, we've done that, and like I said, we have a patent pending for that one. But the main advantage is it reduces operational complexity. You eliminate residual labor costs. You eliminate residual gas cylinder replacement cost. So what are the commercial market opportunities? Well, obviously, QSR is untouched from our point of view. We know McDonald's has made a pretty strong commitment to having a presence in the coffee space. We feel like we have a lot of value to add in that area. So that's as we go through the slide, you can figure out I'm really looking for a strategic partner, somebody that can help us gain access into one of these markets that we're not currently into because we don't have the contacts. Dutch Brothers is an example of coffee shops that have a growth pattern that fits with our technology bringing an advantage to their operation. We are already in several C-stores. We got a market test going with one 100-store chain in Georgia and a 100-store chain up in Indiana. So we're looking to expand and develop a connection with the Aramart family of companies that handle catering business. And then the Compass Group would be another kind of target area we'd like to go. We're in the same area as Primo, so we're going to be initiating talks with them shortly. Here's the vision. This is another aspect of this is a patented credit card activated beverage delivery system, which provides us with the capability of having an autonomous presence. So one of our market development ideas is to see if we can connect with Starbucks, which would give the local Starbucks franchise an opportunity to sell their RTD product, perhaps at, say, a school teacher lounge or other places, so they can leverage their brand against a wider variety of remote locations. This would work particularly well with multifamily units. We've been in touch with a few of those. We have some interest in that area, so we're hoping to develop that particular opportunity. Of course, the Wi-Fi aspect of this allows us to manage our resupply more effectively, and we can deploy it anywhere. It only requires a plug. All of the beverages are self-contained. All righty, so the business model. All right, so I'm basically looking at four broad areas here. The equipment sales, which is actually captured with the bold highlight there, got equipment spelled wrong. So we have the autonomous platform is where we use that KVM credit card activated dispenser in order, that's that platform of our equipment. And then the other equipment sales are related just to generally the box that you saw and the tap head that goes on the counter. Now, one of the things that showed up as a result of our business activity over the last 7 years, we developed a relationship with a company called Hudson Loramo. And so these companies are actually the producers of the beverage concentrate. They need a method to dispense. So we're not just nitro, we're also a very highly accurate blending process. Okay, we use farmer grade pumps and motor controllers. And so we deliver a very high degree of reliability in terms of our product consistency. Running out of time here, so you can see the other areas that we're targeting. So we're seeking, as I said, a strategic partner. We're looking at around 4.5 million in 3 tranches based on performance. We got to fill some key roles in order to actually be able to scale up. We've got regulatory compliance. We need to get some NSF approval in place for some of the larger customers. And then we're, like I said, specifically looking for somebody that can demonstrate the capability to get us in the door with some of these key accounts that we're targeting, or key industries, I should say. So we're hoping you see the virtue or the value in embracing change, leading the future. The nitro world is changing, and we're giving somebody an opportunity to be a part of it. And are there any questions?
Thank you so much for the pitch, William.
Sure.
Yes, so let's start with Mike this time.
Hey, William, how are you?
Good. Hope you're doing well.
Good. My question, I fundamentally understand the nitrogen tank delivery process and how
Sure.
expensive that can be.
Yes.
My question is twofold. One, how does that compare economically? So in my head, I could understand how it could cost more. However, it'd be helpful to understand what is the comparison between the way most people are doing it now to what you're doing now. And then secondarily, just a quick Google search while you were talking, several other companies popped up, including one that looks pretty big called Bunn, B-U-N-N. Are there other people doing this type of stuff? And if so, how are you different?
Sure. So you got, I think, 2 questions, cost and then competitors. So cost-wise, you can buy the nitrogen kit set up for probably $450, $500, I'm guessing, somewhere in that range. But like I said, you've got those nitrogen tanks delivered are about $30 a pop, and so you got a residual cost over the course of the year if you're selling much nitro of another $900 to whatever, $1,200. So so that addresses that the direct competition for the majority of people, what they're using in the specialty market. That's what it is.
And what's the cost of your system? And what's the
sorry?
cost of your system in comparison to that?
Oh, our system,
system.
that little box I showed you is $1,000.
All right. Okay. Got it.
Yeah. Sorry. Forgot to mention that. So, and then you asked me about the Bunn Nitron. The Bunn Nitron is it's about ranges between probably if you're buying 100 of them, you can probably get them for, I don't know, $3,500 these days, maybe 4,000. Onesie twosie there, I'm thinking 4,500 to 5,000. Bunn uses a process called overpressurization, which utilizes obviously Boyle's law. They take the pressure up on the product, normally coffee, to 100 psi, and then as they dispense, as the nitrogen outgasses from the beverage is where you get the cascading nitro effect. So Micromatic's the other big competitor if you didn't pick up on it, and they are utilizing the Spargstone technology, and I can tell some long stories about that, but we're not going into it. So anyway, but those are the two major competitors in the space would be Bunn and Micromatic.
Got it. Then just a little feedback, and I'll pass it along. I think you would be doing yourself a service if you laid some of that out, just the cost profile and how you line up to your competitors.
Perfect.
That's a benefit. That's a benefit. You're saying you cost less in the near term and in the long term, and serve the same or better product is what I'm hearing. So that's accurate. Demonstrate it.
Gotcha. Okay, good feedback. Thanks.
Thank you, Mike. Ben, would you like to go next?
Yes. Thanks for the presentation. Where do you? I have two questions. Where do you plan to manufacture the equipment themselves? Is it in the U.S.?
Yes. We actually have our first round investors are primarily Indian, and they are wanting me to try to take the manufacturing over to India, obviously. And then we have another investor that has a 70,000 foot fabrication facility down in Charlotte, North Carolina. So initially we're going to go to Charlotte, and then if it really goes crazy, we have contacts in India.
So the IP part is within the equipment or within the process or the technology? What is the IP for?
The IP is for the process of infusing a gas into a beverage, okay, using basically a Venturi, okay, and that it has two strong benefits. The first is obviously you're getting the gas infused under a vacuum, so you eliminate all the issues associated with pressure-driven processes. Okay, so I don't know if you know how Venturi works or not, but as a product flows through there under pressure, the pressure drop through the orifice and the design of the Venturi creates a suction, and that pulls in, the gas, which is what we're intending to do. It also creates a tremendous amount of turbulence at the point where the gas is infused, and so we have a really beautiful blending of the 3-micron bubbles with the beverage as it's being delivered in the process. So the other thing that's nice about it is the versatility, because we're actually have made initial contact with a beer distributor, and he's in a state where they're exploring infusion of THC products to try to broaden their product line. And so he's also been interested in the tech, which is what you're asking about there.
Sure. Thanks. And last one, is it a high maintenance equipment, especially the ones that you want to, the self machine that you can pay yourself remotely? So is it a high maintenance one? Otherwise, you will have to have a lot of, maintenance team around, especially if you want to do it worldwide in the US.
Yeah, I'm with you. KBN would provide the best answer on that. They've got 330 machines out in basically 330 multifamily locations out in California, a few in Texas. They're around the country here and there. They're using all RTD product. The maintenance is primarily centered around cleaning the beverage lines, because they didn't have a real good, they're basically selling still only, so we introduced them to still plus nitro, and so that's why they like working with us. But the maintenance issues is not with the head, okay, unless, there's IT tech stuff that, you can, I'm over my head now, okay, so don't ask me to explain all that part. But anyway, if you have they're connected to a Wi-Fi, so whatever the issues are that go with Wi-Fi at a multifamily location, they got those. They generally have to get straightened out because they have to keep doing business in the office, so, they've got somebody else's infrastructure maintaining their connectivity. Other than that, the machine itself is very stable, but obviously, it can be affected by outside sources of interference on the data transfer.
Right. Thank you.
Sure.
Thank you, Ben. Amit, you were raising your hand?
Yeah. So Ben, this is a great technology. I mean, I have an observation followed by a question. My observation is I don't see any third-party validation for some of the vacuum infusion technologies, throughput and taste consistency as the beverage profile changes from coffee to beer, let's say. For example, I don't see that third-party validation similar to my colleague's question before, a competitive analysis that actually matches you with your competitors on various parameters, not only on cost, but also on quality and validation, and validated by a credible third party. That would really, really help, your deck. Followed by another observation, what I do know of these new technologies when it goes into QSRs, that they've got typically a 12 to 18 month of piloting before rolling it out to other stores. Now, that obviously creates a market validation issue, before you can look at revenue. So my question following these two observations, do you have any signed pilots or LOIs or paid deployments at the moment?
Like I said, I think what you're looking for is a cups per day type numbers. And so unfortunately, I don't have anything other than the data we got toward the beginning of our product deployment when we were working with coffee specialty stores. And we were running at that time, again, specialty stores with our product going back 2000. So this was right after COVID. We were looking at around 40 to 50 cups a day. In fact, my original goal was to try to develop residual business out of this. So I wanted to control the retail revenue at the tap was my original goal. I wasn't so much looking for a national footprint of equipment. But anyway, in the process of doing that, I sold a $10,000 machine, and I said, I'll tell you what, just pay me monthly on 50% of the beverage sales. And after paying me $1,000 the third month, he bought the machine. So, I mean, that's the validation is the customer. So that's how that happened in terms of.
I think I'll stop you there, William. So if you're trying to raise the kind of investment that you are, those validations are going to become key for any investor to take a punt in you. If that's not the idea, then if I was you, I would be looking towards licensing this technology to players that already have the footprint that you're trying to create by raising money. Just a food for thought, just my observations and thoughts.
Yeah, I agree. That's definitely a path of least resistance for sure. The part of the raise has to do with the NSF, and then I hadn't considered the third party validation on performance versus the competitors, but that's very legit. So I appreciate that. Certainly, we'll incorporate that into our planning. So thank you.
Thank you, Amit. Okay, maybe just a short last feedback from Oliver, who was raising his hand before we move to the next presenter.
To a shame, I've never tasted nitro coffee. I wasn't lately in the USA, and in Europe it's not so popular. In Switzerland it's absolutely inexistent. Also Nestle is here, and they just said that cold coffee will be the next big thing. I have a question to your to one slide. You said in year one you will make 1 million something. Is this already happening, or is this will this be in the future?
Yeah, this is a projection. Okay,
it's all projection. Okay.
Yeah, projection. We've got, like I said, it's going to be the outcome of these two market tests with these two C-store chains. They both have 100 stores. If I get either one of them, we'll be in the range where that's what I'm projecting from. If I get both of them, it'll be more than that. So.
Okay, thank you for the feedback, everyone, and thank you for the pitch.
Oh yeah,
William?
Thanks for the opportunity. I appreciate it, guys.
Thank you so much. We have now the fourth presenter. It's a video pitch. I will play it from my computer. It's Enviro Farm. So let me just open it.
Founder and CEO of Enviro Farm Systems. As a serial on
Just want to check, did you hear it? Can you hear the sound?
Matilda, it's fine.
Yeah, okay.
entrepreneur with over 50 years experience, I have been involved in multiple business startups. Our current cheese dairy project is shovel ready with site selection, geotech analysis, building permits, layout designs, and environmental approvals in hand. Qualified contractors are identified and ready to bid. Enviro Farm's proprietary green technology, the Enviro Circulator, provides USDA-proven aerobic, nutrient waste, and water bioremediation for reuse and recycling. As with many green tech innovations, aerobic bioremediation does not fit well into existing agri-food production. To fix this, Enviro Farm chose to redesign existing agri-food production systems in ways that provide better green tech benefits and better business results, including increased profits, reduced risk, increased yields, and lower costs. Before we proceed, we need to answer one key question. Why are we here? Most of us are not aware that modern agri-food production is collapsing. Degraded topsoil offers less and less nutrient-dense food year after year. As a result, farm fields can no longer provide food as health. The low nutrient density in food we buy today contributes to epidemic obesity and diabetes. The methane from food production contributes to climate change, while ammonia emissions create significant public health problems, including childhood asthma, elder emphysema, and cancer. Adding an estimated $270 billion per year in U.S. public health costs. Enviro Farm's aerobic production systems offer effective solutions to all of these problems. Even while producing more nutrient-dense food at lower cost for consumers and with higher profits for producers. Here are the steps in how it works. In step 1, nutrient waste is automatically washed from the barn every hour, leaving floors spotless and odor-free while providing earth temperature cooling surfaces for cow comfort. At step 2, nutrient wastewater is sent to storage basins where it is transformed into safe, odor and pathogen-free, 99% true liquid fertilizer. At step 3, whenever plants need food and water, fertilizer is pumped from storage. At step 4, liquid fertilizer is sprinkled directly onto growing crops in precise quantities required. Step 5 simply shows reclaimed safe water being recycled for barn cleaning. Specialty cheese production was chosen as our first project due to sustained 5 to 10% growth over the past 20 to 30 years. Specialty cheeses began trending higher as consumers looked for convenient, tasty food with better nutrient density. Just 2 years ago, the term car cheese, meaning cheese to be eaten as a snack in the car, came to the fore when mentioned on TikTok and Instagram. Consumer cheese demand suddenly surged again. In addition to the founder, the Enviro Farm startup team includes managers with extensive experience in each separate area of agri-food production and operations. Each team member has over 20 years of independent business experience, and team members have now worked with each other on this project for over 5 years. Team resumes are available on our website at enviro.farm. The current Enviro Farm cheese dairy cap stack, totaling 153 million, can be initiated by as little as 2.5 million in pre-seed round. This is followed by a 15 million Enviro bond available from the state of South Dakota and a 10 million community development bond running parallel with a full 25 million seed round. Bonds and seed rounds are followed by 100 million from private loans to reach the total 153 million projected cost. This is offset by an estimated 30% internal rate of return, producing a projected cumulative EBITDA of 160.5 million by the end of year 6. Deeper participation by interested investor lenders can be discussed. Let me sum up with answers to several obvious questions. There is an urgent need to address agri-food's role in climate change, consumer health, producer profitability, agri-food sustainability, and the regenerative soil crisis. Investors and industry are looking for real change. Enviro Farm provides that. The current project solves all the fundamental industry problems facing new production and taps into surging demand for nutrient-dense specialty cheese. Our first site has been named in South Dakota, and a seasoned project team with deep industry knowledge has been assembled. Multiple additional sites are planned as soon as this one is underway. Allow me to leave this final slide on the screen as we conclude. Please note the last item on this list may be new to you. At the request of previous interested parties, we retained a top qualified CPA firm in the agri-food dairy industry to conduct due diligence regarding our business plan. Their conclusion was a surprising 90% likelihood of success. Not something one hears every day from a CPA firm. Their 45-page report is available on request. Thank you for your interest and attention in our project. I can take your questions and comments now, please.
All right, this was a video pitch. Who would like to start? Should we start maybe with Peter? Just an idea. Or Mike?
I'm here, but I may have a question, but I'm gonna pass on the first one because I'm not
Okay.
familiar with agriculture.
Okay. Then Amit?
Yeah, hi. This is kind
Yes.
of my domain. I
Okay.
fund a lot of these technologies, which comes out of universities. This is really, really capital intensive on the first look. and generally not your typical angel investment or VC play, if I might kind of use that word. Now, given, and that's fine, there's nothing wrong with that. Your projection, basically your financial projection rests on unbuilt facilities, unproven technology at scale. I mean, it is USDA proven, and this 90% likelihood of success comes from a CPA-based due diligence firm rather than an independent technical agronomic auditor. When you're going in, this is just observation, when you're going in for a project of this scale and size and money, it would really help to get an independent agriculture advisor on both the technology aspect of it, whether the technology works at scale. And I'm not saying that it does not, but for investors who will underwrite checks of this value, they would need to have an independent firm validated, a specialist in agriculture technology, number one. Followed by obviously your capital stack mix. I mean, there's a mix of equity, there's a mix of probably grants available, and a mix of private loans that I don't understand on what collateral, where is the collateral against those private loans? Now, my questions are, has this technology, the Enviro circulated technology, ever been operated at a commercial scale in any existing dairy farm in the world? I'd like to understand that because it is a big bunch. That's number one.
I can answer the question, Amit. First of all, yes, they're out individually at a number of farms throughout the Midwest United States, and they are working successfully. It has proven the technology and it works successfully. What's very difficult is for farmers, given their propensity to borrow all the money for their crop field first, to be able to justify the cost, because you also then have to transport the liquid fertilizer. It turns manure into fertilizer. Manure is not fertilizer. Manure is becoming fertilizer. And once it's properly aerobically, not anaerobically, but aerobically treated, it becomes excellent fertilizer. It's pumped out in the field and applied with a pivot at the appropriate time using AI on sensors about when the crop needs the growing, not only the growing nutrients, but the liquid as well, and the robotics. So there's AI and robotics involved, and that has been addressed. Secondly, the one premise is incorrect that you said about the CPA firm. That CPA firm is the largest dairy CPA firm in the United States, and they have independently owned a number of dairies themselves, Genski, and that's why he felt very confident about looking at this. And again, there's a 45-page with comparisons on industry standards and compared to the pro formas that Enviro Farm is putting forward. There's a 45-page report with very detailed comparisons. It's real. It really works. It really is capable. The fact that the farmers can't really independently transport the fertilizer once it's completed, it has to be adjacent to a farm field. We will have that. We have the farm fields already adjacent. It'll go out by pipeline and pivots very efficiently. No transportation. It beats the environmental problem of having to haul milk to a cheese company. We're doing it with a cheese company on site. We're saving the environment on transporting the manure, and we're applying it at the exact proper time using AI to get the most efficient use of the whole intellectual proprietary process that we have. So, and lastly, our cheese guy's from New Zealand, so I thought you might like that. He's one of the world's leading cheese persons. It's listed on the website, and he's from New Zealand.
So from my perspective, what you would still need is a non-CPA, because CPA looks at everything from a very different lens to an agronomic technology expert, it would probably help, in addition to the report that you have, to get an independent agriculture technology specialist firm to be able to validate this waste to fertilizer conversion rates and cost savings.
Amit, if I might interject,
Sure.
there is an answer to your question, and
Right.
and it lies in the background. I'm sorry.
Right.
The USDA commissioned myself as the director of an agricultural project and the technology that was available for 3 years on 11 farms to study the agronomic impact of aerobic nutrient waste transformation. And when they were finished, they went ahead and offered farmers a grant, a significant grant, about a third of the cost, to actually be able to acquire this technology. As Mike pointed out, and unfortunately, farmers do not have the funds to acquire the technology and insert it into a system change required to use it. So the technology agronomically is completely proven on independent sites by the USDA's independent evaluation, and that report is available from the US government. The second problem we have is the cost of the business process itself. And in order for that green field in the background of my screen to continue to grow, it has to be revitalized. And farmers are told they must regenerate their fields, or within 10 to 15 years, they will not be able to grow a crop. We're talking North America here. We're talking one of the most productive farming centers in the universe. Europe is a little better off than we are at the moment, but not much. And other countries are not either. So there has to be a way, a system developed whereby the farmer who owns the field is able to profit additionally from the processes that are going on, and that's able to get to market, directed into a market that in fact is surging in demand. And the latest surge on the specialty cheese market is the fact that it produces a protein-based snack. And protein has suddenly become a buzzword in nutrition today. So the agricultural technology is proven. The business model is essentially a manufacturing business model. It is not difficult to understand. It's based on a 10-year, month-by-month, item-by-item production system, which is no different in business concept from any other manufacturing system. It just uses different tools and technology, which are proven and which do produce a higher output. Because we have the cheese factory on site, Mike mentioned we don't have any milk hauling to accomplish, but the real benefit comes from the fact that we can dispose of the whey. 10 pounds of milk produces 1 pound of cheese and 9 pounds of whey. When that whey gets left in the hands, they have to build a second big factory to change it. Our whey factory are the cows. Cows love to drink whey, but it has to be fresh the same day. Can't be hauled off and brought back, or it goes sour and they won't drink it. When cows drink whey, and they will consume most of the whey coming out of the cheese factory, they produce 15% more cheese products. So in effect, by setting the system up this way and using the vertically integrated stack, we are achieving a 15% higher production with no additional costs. And we have in fact cut the costs by 20 to 30% on everything that we do. So it's forgive my saying so, it's an amazing, well-established, well-defined project. It's very large, and this is just one site. We want to have 10 of these sites up within the next 5 years, and we want 100 sites up in the next 20 years. Why do I say that? Because food production is dying. It's literally dying on the field behind me. Thank you.
I have one other thing, Amit, you asked about collateral. 95% of the capital used for the project is with hard, fixed, marketable assets. From the dairy herd, which is $45 to $50 million, to the dairy itself, which is marketable, to the cheese company, which again is a marketable asset. So the large amount of capital that's required, and it is 95% are fixed assets and marketable in a very short time period. Lastly, we have a very large distributor, a financier of distributors for kosher cheese products from metropolitan New York that has already spoken with us. I've dealt with him since the 1990s, and he's already looking at $100 million in debt, along with ABL financing or asset-based financing for this. He sees the value of it. He wants his part of it on the distribution. We even have a line item for rabbinical supervision in the cheese company. We have all of that covered, and we've already discussed all those marketing options in advance, and it's they're ready to get started. We need something in the $25 million range to get started and have the rest of the money, 25 from South Dakota, and another $100 million from New York in the form of long-term asset-based debt. And so it's a relatively small amount that we're looking for in the total capital, and we have the rest.
Thank you.
Thank you, Amit. Ben, would you like to go next?
I don't really have a really question. I just have a question about the waste. It seems that it's a closed ecosystem, but is there any waste that goes somewhere in the process?
Thank you, Ben. It's not waste when it goes somewhere. It's actually fertilizer. But the way that the disposed of material goes out is by pipeline to sprinkle on the crops, to feed the crops, and it comes from what we used to call manure, but at the moment it is now liquid fertilizer that's sprinkled on the crops. That's where all the waste goes.
But is it 100% converted into a feed? Or
he's talking, Bill Tooley. Ben is talking about the whey.
Oh, did you say whey or waste?
No, no. Even the way to produce it, it seems that your system is 100%. It's a no waste system.
Correct. It's a completely closed system. That's right.
Okay.
Thank you, Ben. It's an important point.
Thank you. Mike, would you like to add something? Mike? Or Bryan?
They all left to go write checks to us.
Oliver?
I'm here. I'm here. Nothing to add. Nothing.
Okay.
Agriculture is not my expertise.
Okay.
So I'm listening and learning.
Okay.
Thank you. Thank you, Mike.
Agro and agronomy is something that we do quite a bit of, but this would definitely be an offline conversation.
Absolutely. Thank you.
I believe
and I understand that
one of my coworkers is sending you an email.
Thank you.
I greatly appreciate the fact that some of us have been around farming and agriculture all of our lives, and some of us have just eaten the food and it comes off the grocery store shelf the way my children think it does. So it's a complicated, difficult, easy to accomplish once understood process. Thank you for listening.
Yeah, we need it's worthy of an offline telephone call to dig into really what's going on, because I don't think I've got a very good view of what your project really is. And there's a couple of snuck premises in there that you did on your very first slide, and those were a little bit sneaky. So it's called a snuck premise. So we need to sit there and tear that apart. So there's some logical fallacies, but if that can be torn apart, you might be onto something pretty interesting here. And this is exactly the right size for what my company does.
All right, Bryan, thank you.
So
we will talk.
Thank you, Bryan. Oliver, Peter, do you have something to add?
Nothing to add. I'm not in the agri tech.
Okay. Peter, no?
Yeah, also from my side, very interesting presentation, but little to add.
Okay.
Thank you.
Great. Okay, so this was the last presenter tonight. Want to thank you everyone for joining. Thank you to the advisors for joining this event. The presenters did a great job. Apologies for running a little bit over time. I hope it doesn't matter too much. You're welcome to join on some next events. I've shared the link to the upcoming events, and I will be sharing the contact list and the recording. Hopefully tomorrow already. So
Mathilde, thank you for sharing your holiday time with us and for taking that away. We know.
with pleasure. With pleasure. I love these events. Thank you so much. I wish you a good evening or a good day, and let's just keep in touch for the future. Thanks
Thank you.
again.
Thank
All
you.
right.
Thank you.
Goodbye, everyone.
Bye-bye. Take care.
Take care. Bye bye.